As we head into 2023, a contrarian large-cap China internet name we'd like to own is Tencent. Tencent has been a consensus short year to date. We believe an inflection is coming, driven by monetization of its short video asset, i.e. video accounts. Tencent has been investing heavily in its short video businesses for the past 2 years, and yet investors are still very skeptical and underappreciated. Despite management's significant change in body language in second quarter earnings and subsequent NDRs about video accounts monetization potential, investors are skeptical because A, there's no straightforward data points to verify management's claims, and B, investors were wary of the previous consecutive quarterly misses in the ad businesses. Our proprietary analysis of the data that's not widely available to the street allow us to come away much more positive than the street about Tencent's video accounts monetization potential and advertising revenue. On top of the advertising upside, cost optimization and easier comps will allow Tencent to resume earnings growth starting in fourth quarter this year, regardless of the macro environment, thus protecting us from the downside. At 21 times consensus NTM earnings, Tencent is trading at historical low multiples. If exit multiples stay at 21 times, earnings compounding itself will drive forecasts to be 45% by year-end 2023 in our base case. Our downside case is limited at negative 10%, while upside is north of 80. So risk reward is clearly asymmetric. Page 4, executive summary. During the second quarter earnings call, Tencent management surprised the market by uncharacteristically talking up the monetization potential of video accounts and guided accelerated ramp than its previous WeChat products on ad revenue. Based on our differentiated analysis on user engagement, revenue sizing, and gross margin buildup, we see significant earnings upside of video accounts currently underappreciated by the market. If we are correct, video accounts ad revenue can potentially reach half of Tencent's total ad revenue today by 2025, driving Tencent's earning upward revision. Our key differentiations are in the following 3 areas. First, user engagement and revenue sizing. Our proprietary analysis using differentiated data allow us to arrive at a materially higher user time spent for video accounts than the market believes, and consequently much higher revenue potential. Secondly, historical management commentary analysis. Our more detailed look-back analysis on Tencent historical commentaries on video accounts allow us to have higher confidence on the reasons driving Tencent's positive tone on video accounts. This shift is more gradual than abrupt. Lastly, gross margin analysis of ad revenue. A better understanding of incremental margin of video accounts resulted in materially higher ad gross margin than what the street is currently modeling. Our base case is 7% to mid-teens percentage higher than street on adjusted net income basis from second half of this year to 2025. Assuming no multiple re-rating, base case has 45% forecast. Video accounts monetization could also potentially change the narrative for Tencent from a ad market share loser to a share gainer, resulting in multiple re-rating to historical average premium to HSI in our upside case. A 0.2 belief, Optimizer recommends owning 165 million position for the blended forecast of 44%. Page 5, forecast and valuation. Charts on the right shows historical valuation and premium versus HSI. We're currently at a 5-year trough, both on a standalone and relative to indices basis. In a new regime where China internet names are growing slower top line with more focus on earnings growth, we expect Tencent to be a mid-teens earnings grower in 2024 over 25, with blended forecast of 44%. Page 6, table of contents. For the detailed discussion, later. We will A. quickly walk through each of Tencent's main segments. B. Elaborate our thesis and differentiations. C. Discuss forecasts and valuations and near-term headwinds. Page 8. Tencent revenue by segment. This is a snapshot of Tencent's segment mix in a decade. Gaming business is self-explanatory. Tencent is the largest gaming developer and distributor in the world. Tencent is also the largest social network operator in China, with 1.3 billion MAU in WeChat and 800 million MAU in QQ, among others, through which it monetizes through A. value-added service to consumers, including video, music subscription, virtual gifts, etc. B. online advertising. Lastly, Tencent operates China's largest online payment network with over 50% market share, with fintech accounting for 75% of the segment revenue, of which mostly are commercial payment revenue. And the remaining 25% is cloud and SaaS products. Since 2017, Tencent has transformed from a predominantly domestic gaming company with 50% of the total revenue to a more comprehensive internet platform with domestic gaming accounting for a quarter of the total revenue today. Page 9. From a margin perspective, Tencent historically enjoys stable and high gross margins for each of its main businesses. 2021's abnormality was due to a number of factors, which can be grouped in two buckets. A. Self-reinvestments, namely in video accounts, international gaming, and business services, all of which were costs with little to no top-line contribution. B. Impact from regulatory crackdown. Demand weakness in ads as a result of crackdown on education, fintech, gaming industry, etc. In addition, there is also increased compliance costs on gaming due to the new regulatory policies on restriction on minors gameplay. Starting in first half of this year, while macro weakness continued to weigh on ad margin due to the deleveraging effect, segment margins began to inflect as previous top-line impact started to annualize, as well as the cost optimization effort were being executed, especially in the fintech and business service segments. Going forward, we expect margin to continue recovering, driven by all the factors in the first half of this year, as well as increased monetization of video accounts, which has high incremental margins. Page 10. Gaming overview. Tencent has a dominant leadership in gaming due to three drivers. 1. Superior gaming development capability proven by high grossing titles. 2. Unparalleled distribution capability leveraging WeChat's social network of 1.3 billion MAU. 3. Disciplined monetization strategy allowing it to have the resilience in market downturn. From the chart below, we can see user engagement is not a great indicator for gaming revenue growth. A better indication of a gaming company's fundamental strength is growth rankings, which we'll discuss next. Page 11. The key takeaway from this page is that Tencent has great track record in extending longevity of its existing titles, as well as launching successful new games. Of the top 12 grossing mobile games in China, half of them were developed by Tencent. The oldest game, which happened to be the top game, was developed by Tencent, and the newest game was also developed by Tencent. Page 12. Regulatory shock in the past year. This page shows regulatory impact from a time span perspective. You can see key existing titles saw time spent drop significantly last year due to restrictions in minors gameplay, and we see stabilization in recent quarters due to the policy annualizing. On the other hand, Tencent's gaming revenue saw low single-digit decline only in the past 2 quarters due to its diversified gaming portfolio and successful new game launches. While gaming industry will likely still experience softness in the next few quarters due to the weak macro and lack of new major titles, we expect industry to gradually recover as the gaming license resumed in April for the industry and in September for Tencent. Page 13, financial forecast. Financially, we expect third quarter gaming to be a bit worse than second quarter on a year-over-year basis, while 2023 should see moderate recovery given the lower base and new game launches. For gaming, our base case is still single-digit below street. In a downside case, where we model gaming revenue decline by a further 5% year-over-year in 2023, lower likelihood in our view. The loss in gross margin, assuming 60% incremental margin, is largely offset by the beat in ad gross margin, which we'll discuss in later sections. Page 15, ad overview. We already covered ads segment briefly in a segment overview page earlier. Second quarter this year saw ads bottom out. We expect sequential improvement of the existing ads business going forward. Incremental revenue from video accounts will drive further upside. Lastly, business and fintech and business service segment. Not super differentiated here. Top line is expected to be muted due to COVID restrictions as well as cloud business experiencing restructuring. Profit, however, is expected to sequentially be better due to management's focus on high margin projects. Page 17. Now back to our key thesis. Number one, differentiating area is video accounts user engagement and revenue sizing. One of the key debates on monetization potential for video accounts is user engagement and time spent being very low. Contrary to most investors and sell side who believe average daily time spent for video accounts is currently in a range of 10 to 20 minutes. We believe the average time spent exceeds 30 minutes and could well be above 40, a game changer for the ad revenue opportunity. More importantly, our conversation with ad industry experts confirm that the engagement was still growing robustly, and we believe monetization could accelerate that engagement growth. Leveraging QuestMobile, we see WeChat's average LTM daily time spent per DAU growth declined sharply since 2017 due to share loss to short-form video platforms such as Douyin, but stabilized and even started growing since early 2020. Coincided with when Tencent launched its video accounts. Therefore, we could safely assume the growth of WeChat daily time spent was mostly due to the increased engagement of video accounts. Page 19. This chart shows WeChat's daily time spent growth versus market share among other short-form video platforms. Since the launch of video accounts, WeChat's market share loss meaningfully stabilized. Page 20 and 21. How to quantify the daily time spent for video accounts itself. We take WeChat's total time spent minus the time spent of WeChat's non-video accounts properties, assuming a certain growth rate based on previous momentum. If we were to assume the decline momentum in time spent for WeChat's non-video account properties to be around negative 5.5% year over year today, the implied time spent per DAU for video accounts is 30 minutes. If we were to assume the decline momentum further deteriorated to negative 9.5% year over year for WeChat's non-video accounts properties, which is more likely as non-video content declines at an accelerated pace. The implied time spent per DAU for video account is 40 minutes. Page 22. Another way to quantify video accounts time spent per DAU is to first infer time spent for WeChat's moments using Kuaishou as a reference point, based on their difference in metrics including ad revenue, ad load, eCPM, and DAU, etc. And then using the information given by Tencent, i.e. 80% of the total time spent of moments, to triangulate daily time spent for video accounts. Using this methodology, we estimate average daily time spent for video accounts to be 46 minutes. Page 23. Now that we established that the daily time spent per DAU for video accounts is 40 minutes, using Kuaishou as a reference, we estimate total ad revenue could reach above 40 billion by 2025. Below, we show the math and sensitivity based on ad load and daily time spent assumptions. There are two ways to translate time spent to revenue: revenue per minute method and eCPM method, which both follow the same logic. The chart below shows ad revenue per minute method. Using Kuaishou as an example, its revenue per monetizable ad monetizable time spent is 15 RMB in the last 2 years. If we assume WeChat's pricing is higher at 20 RMB, ad revenue could potentially reach 50 billion plus by 2025. That is 70% of WeChat's total social ads revenue today. eCPM method yields a similar conclusion on revenue opportunity. From our conversations with ad agents who work closely with Tencent, and some of them who had direct conversations with Tencent's video account sales force, our numbers were roughly in line with the near-term and their long-term revenue target. Page 24. Sensitizing time spent and ad load, we see long-term ad revenue opportunity for video accounts in the range of 40 to 70 billion. For modeling purposes, we expect video accounts to ramp to 11 billion next year and 24 and 41 billion by 2024 and 25. Total ads are 9%, 14%, and 20% higher in the next 3 years than street. Page 26. Our second area of differentiation is the historical look-back analysis on management commentaries regarding video accounts, which give us more confidence on the reasons driving the monetization acceleration today. Page 27. Historically, Tencent was very restrained about monetizing its assets, be it WeChat or gaming. In second quarter earnings, management had a dramatic change in body language and uncharacteristically talked up the monetization of video accounts and guided on accelerated pace of ad revenue ramp. While the market was still suspicious about the video accounts TAM and potential cannibalization of Tencent's existing WeChat ad revenue, we believe Tencent could surprise on upside for the following reasons. 1. User growth and time spent have already reached critical mass. 2. Video accounts do not cannibalize with the existing usage of other WeChat properties. Use cases are very different, which means A, video accounts revenue could well be largely all incremental revenue, and B, Tencent could be more aggressive in increasing ad load as it will not impact user experience of other WeChat properties. 3. Short-form video monetization has very mature business models, such as Douyin and Kuaishou for Tencent to follow, as in the case for Douyin and Kuaishou for Tencent to follow. Page 28. Historical commentaries on video accounts. Going through the historical earnings transcripts in more detail, we compile the main data points on management's commentaries on video counts, user metrics, and monetization. The language on monetization changed from being not a focus a year ago to the largest revenue opportunity and higher revenue than WeChat Moments in recent quarters, as the user metric continued to grow healthily over the course of the last 2 years. Second quarter was a clearly inflection point, yet the process was more gradual than abrupt. Page 29. Lastly, our third area of differentiation is gross margin. In a segment margin overview, we discussed ad gross margin decline due to deleveraging effect from the declining ad revenue and investments in video accounts over the last year. However, as Tencent starts to monetize video accounts, what were previously all fixed costs because there was no incremental revenue will now mostly become variable, and a high incremental margin of video accounts ads will drive ad gross margin to be materially higher, even higher than the pre-2020 level. Street currently only assumes mild gross margin improvement for ad business in 23 and beyond, materially below the 2020 level, on par with the 2021 level, an investment year for Tencent, even by 2024. The implied Street incremental margin shows that the Street does not properly factor in the high incremental margin nature of the video accounts. As a result, our ad gross margin is higher than Street by 15, 28, and 35% in second half of this year to 2023 and 2024. Page 32. Back to forecast. Our base case has earnings growing at mid-teens percentage in 24 over 25, with earnings of high teens above Street. Without multiple re-rate, we have 45% forecast. Page 33, we've looked at how historical top-line growth corresponded to premium to HSI. If top-line recovers to low teens, we expect premium to HSI to be around 120% for Tencent. Page 36. Lastly, we've considered selling pressure from Process and Naspers. Prior to second quarter earnings, Process Naspers sold about 2 times the amount of Tencent stock than the size of Tencent's own buyback. After second quarter earnings, Tencent upsized its own stock buyback to a similar size of Process and Naspers selling. While we expect Process and Naspers continue to sell Tencent to fund their own buybacks, there's enough cash for Tencent to support its own buyback for as long as it takes. That concludes our prepared presentation. Happy to answer any questions.